Yeah, good afternoon, everyone. Today we'll be looking at international investment decision. International investment decision. Uh, this topic has to do with MPV, and I know that Mr. Ezekiel has taught you MPV and investment decision. So we'll just be looking at the international aspect of this investment decision. Now, what do you mean by international or foreign investment decision? There may be a company in Nigeria that wants to invest in a company abroad, or that wants to carry out an investment that is not a domestic investment, let's say a foreign investment. Now, that maybe there's an opportunity in other country, and in that country where that investment will be carried out, don't forget that that country is not using, they are not using the same currency. That means the currency in which they are using is different from that where the company is domiciled. That means that is international investment decision. So they will have to make a decision. That is international investment. So the decision, international investment decision will now be, should we invest or should we not invest? And that's why we will be looking at NPV. We will be calculating NPV. And you know that when an investment, when the NPV of an investment is positive, it is agreed that investment is worth investing. So it's viable, so you can invest. But if it is negative, if the NPV is negative, that means that investment does not worth investing in. And that's what organization has to look into. So they will need to calculate whether that international investment, whether it will yield positive investment, positive NPV or negative NPV. And when you are calculating NPV, what are the most important things you need to consider? You need to know the cash flow. That means the cash outlay. That means the initial cash outflow, and you know the cash inflow that will comes in as a result of that investment. So you discount it, you calculate the discounted cash flow, and you compare the discounted cash inflow with that of the initial cash outflow. So you now know whether it will result to positive NPV or negative NPV. So with that, now they can ask you that what are the factors that affect, what are the factors that can affect investment decision, or what are the factors restricting foreign investment? What are the factors that can restrict foreign investment? Now, number one factor that restricts foreign investment, there may be opportunity in another country, and the company may decide not to invest due to some factors, and that's the factors that we are looking at. One of the factors is infrastructure. Are we together now? Infrastructure. Now, infrastructure may restrict an organization to not to invest. Am I communicating now? Let's say you don't have hospital in that country, and there is investment opportunity, there is no electricity, there is no infrastructural development in that country. It may actually restrict foreign investment. Now, another factors that can restrict companies from investing in international opportunities is the standard of education in that country in which they want to invest. In that country, in that company, that foreign company they want to invest in. If there is the level of education is poor, that means they need to get people. That means the level of expertise that is in our country is very poor. That means for them to now invest, they will need to bring people from different countries to invest into that opportunity that has been identified in that foreign company or in that foreign country, it may actually restrict foreign investment. What about political risks? Political risks. Political risks can also restrict the may actually restrict investing or carrying out international investments. And what do you mean by political risks? That means political risks has to do with the decision, with the government decision. Those government decisions that will have an adverse effect on the investors that want to invest in that country. So it may actually restrict companies from investing. We also have the economic risks. Economic risks. People prefer to invest in developed countries, because their economy is well developed and well structured than underdeveloped or developing countries. These are factors to consider. What about taxation? Is one of the factors to consider. Taxation. There are some countries where their tax is very high. There are some countries where their tax is very low. There are some countries where you have tax holiday. And also exchange rates. Exchange rates can also be one of the factors that can restrict if the exchange rate is unfavorable. Now, since we have looked at this, so we have looked at the factors that you need to consider or that can restrict international investment. So let's look at what are the features of investment in foreign countries. That means companies that have decided not to invest in their domestic currency, in their domestic country. They have now decided to invest in a foreign company that is not domiciled in that domestic country now. What are the features? What are the things that you will see what are the things you will see? What are the characteristics or that you will see if a company wants to invest in a foreign company? So let's look at the features of a investment in a foreign country. I will advise that SFM is not only about calculation; we also have written aspect of it. So let's look at this now. Now, the investment. One of the features that the investment in a foreign country. One of the features is that the investment we have an high risk investment. It's an high risk investment. When you decide not to invest in your domestic currency, but investing in another country, investing in a foreign country, that means the risk involved in that investment is going to be very high, because it's not something that the company is used to. It's another terrain itself. So the investments contain an high risk. Now, one of the other features is that the cash flow that you are going to receive, are we together now? That you are going to receive from such an investment is going to be, or that you are going to use to invest into that country is going to be a foreign currency. That means the currency in which that country is using, that's what you will get to invest. It's just like let's say I'm in Nigeria and I want to invest in the company that is in Kenya. That means if I want to invest in the company that is in Kenya, that means I will need Kenya currency to invest in that country now, because that's the currency which they are using in that country. So you will need that most of the cash flow for foreign investments is going to be the currency of the foreign country. Am I communicating? Now, that is. Now, the interest rate is going to be what? Different. The interest rate is going to be different because the interest rate, the inflation rate, let's say that country is a developing country and your own country is a developed country. That means the inflation rate is going to be different. It's going to be different. So there will be need for you to make allowance for inflation if their inflation is not the same. Am I communicating? You make allowance for inflation. Now, also, there may be restriction on how much cash inflow that a company can collect. For you to invest, that means there will be cash inflow. If you invest, there will be expected cash inflow. Now, in that country, they may put a restriction on the amount of cash inflow that can move out of their country. Are we together? So there may be a restriction on the amount of payment. That means amount of payment from the foreign country. Don't forget, we have invested. And if you have invested, you want to get return for your investment. That means the foreign company wants to pay you dividends or pay you a cash inflow for investing. That country may have restriction. And the restriction they have may not allow you to receive the whole cash inflow for a particular period. So they may say that for any payment moving out of that foreign country, it must not be more than $20,000. That means if for a particular period of time, let's say in a year's time, your expected cash flow is $30,000 because it's $30,000 now, and the restriction the government has put on money going out of their own economy or out of their own country which you have invested in is $20. That means you cannot receive this 30. That means you can only recognize the cash inflow of $20. The remaining $10 will be what? Will be brought forward to another period. Let's say for a particular year, they said the maximum amount that you can go out of the economy is to a particular person is $20,000. And you can see that means you will receive $20,000. Let's say in year one, let me just give you an example. And the remaining balance will be received in the next year, which is $10,000. You can see the restriction. And these are the things you will see. But let's go into the calculation aspect now. Let's move into the calculation aspect of international investment appraisal. So I will be teaching you some things because I expected you to know those things that have been taught by this certificate. Now the question is now, how can you calculate NPV? There are two methods that you can use to calculate the NPV of a foreign investment. Two methods that can be used to calculate the NPV of foreign investment. Now, don't forget that we are talking about international investment appraisal, international investment decision. So that means it is when the NPV is positive, that's when you can say, I want to decide I can accept the investment. We can accept to invest in that international investment. But if it is negative, you will need to what? You will need to reject that investment. So let's look at the two methods for calculating NPV for international investment. So method of calculating NPV for international investments. So I was talking about two methods of calculating NPV for investments, for international investments. So there are two methods that you can use. So number one method is what we call, you discount the foreign currency cash flow. You may not understand it now, but when we are solving the calculation, we look at the two methods. Are we together? With the foreign discounts or discounting rates, the foreign discounting rate, and you translate to domestic currency. Two, I'm going to explain, we are going to solve calculation on this, but don't worry, just you discount that means you calculate the cash flow, the discounting cash flow of the discounting cash flow of the investment. So once you calculate it using the discounting rate of the country where you have invested, that means they will give you the discounting rate for both the domestic country and for the foreign country. So, but we are using the foreign domestic discounting rate. After you have calculated it now, you now translate it to the domestic currency. Don't worry. When we are solving, we solve the calculation now, so you see what I'm saying. So, second method is you translate the future cash flow. Okay, the future cash flow. Let me just say the foreign cash flow. Let me just put it like that. The foreign, because the future cash flow is going to be in the domestic currency of the country where you have invested. So translate the foreign currency cash flow to domestic currency. So after you have done that, you now find the discounted cash flow. So discount it using the domestic discounting rates. So these are the two methods that I can use. But don't let me stress us, just know this. So let's go to a question. Let's look at a question and solve that question using the two methods. So now the question we want to solve, let me write the page 500, SFL, page 500. So let me read. They said a Nigerian company is considering an investment in a project in Ghana. Can you see that one? They want to invest in a project in Ghana. Can you see now? Right? It is international investment appraisal. It is international investment. You have to carry out international investment appraisal now to appraise that project, whether to decide whether they should go ahead with the project or not to go ahead with the project. Whenever you are given a question about investment appraisal and it is outside the country in which you are domiciled, it means it is international investment decision or appraisal. Am I communicating now? So like this one now, it's not Nigeria. If it's a Nigerian company now that they said a Nigerian company wants to invest in a project in Nigeria, it's not international. So A Nigerian company is considering an investment in a project in Ghana. The exchange rate for Ghana cedis is 50 naira to 1 cedis. That is what? Direct. It's direct. So there is no how. The question is on page 500, SFM 500.
Is it study park?
Yes, study park. Yes, study park. Okay. Now, the discount rate for the project in Ghana is 10%, and the discount rate for similar projects in Nigeria is 8%. That means if they decide to invest in a project in Nigeria that is similar to that of that investment they want to invest in Ghana, they also give us the discounting rate, which is 8%. Now, they said the project will require an initial investment of 100,000 cedis. That means the project, the initial layout, which is the cash outflow, is 100,000 cedis. They said and lead to cash inflow of 50,000 per annum for the next 3 years. So for 3 years, they will be getting 50,000 cedis for that investment. Don't forget, what currency are we using in Nigeria? Naira. Why? The currency they are using in Ghana is cedis. That means both, because they are investing in a project in Ghana, they will, what most of the investments, now we can say that this investment is in foreign, both the cash inflow and cash outflow is on foreign currency. Now, they now say that we should find the NPV of the what? Of the project now. So we want to calculate the NPV. No, now, you can decide to use method 1 and method 2. So what do I call method 1? What do I call method 1? You discount the what? You find the discount for the foreign currency cash flow. That means what's the foreign currency cash flow in this question now? What's the foreign currency cash flow in this question? That means we have 100,000 cedis, which is the cash outflow, and cash inflow is 50,000 cedis for the next 3 years. Am I communicating now? Am I communicating? So let's discount it. And they have given us the discount rate for the discounting rate for the project in Ghana. What was the discounting rate? 10%. Am I right? So method 1. Okay, let me write the. Should I write the?
You are fast, like I'm not even from the kind of.
Okay, let me write the. Okay, method 1 says that you should discount the foreign currency cash flow. Are we together now? Using the foreign discounting rates. Are we together? And after you have done that, translate it to domestic currency. The domestic currency at, okay, I didn't put that in that first one I wrote, at spot rates. So they have given us the spot rates in this question. So let's see how it goes. So this is how to do it now. So let's solve for it. So we have here we have the cash flow. Are we together? We have the discounting factor. Now, the discounting factor to use, what discounting factor did they say we should use? The foreign discounting rate. And the foreign discounting rate in that question is what? What's the percentage? 10%, thank you. 10%. So after I have done that, we will now, don't forget that the cash flow is in cedis. And we will now find the present value, which will be in cedis also. But let's do that first. Year zero. Year zero is how much? What's the cash flow? 100,000. Year zero is when the investment was initiated, and because the investment was initiated, they need to pay an initial outlay, or we call it cash outflow. So how much is it? 100,000 cedis. Don't forget, what we are calculating is we discount the foreign currency cash flow using the foreign discounting rate. So what will be the discounting rate in year zero? It will be 1. Don't forget that to calculate discounting factor, it will be 1 over 1 plus r raised to power what? N. Our n here is 0. So if it is 0, everything here will be 1. By now, the reason why I teach this topic late is because I want Mr. Ezekiel to teach you investment appraisal first, so that I will not be stressing myself. So the discounting factor, let me just, so the discounting factor will be 1 plus r raised to power n, and that will give us what? That will give us what? That will give us what? 1. Okay. 1. Don't forget the rate is 10%. So 10% will be 0.1 raised to power. The year is what? Is 0. So if the year is 0, you don't even need to calculate everything. Anything raised to power 0 is what? In your calculation, anything raised to power 0 is 1. Am I communicating? Okay. So this is the formula for discounting factor. So I don't want to rewrite it again. So you already knew that. So 1 plus r is 0.1 raised to power is 0, which is equals to 1.00. So you can do it 4 decimal points. So let's go to year 2 now. So don't forget is cash outflow in year 0. So it will be bracket because it's moving, that money is going out of the company. So 100,000 times 1.00, that will give us minus 100,000. So let's go to year 1. It said the cash flow, you can calculate, it said the cash flow for the next 3 years is 50,000. So you can do it 1, which is 50,000. It will be negative because it's cash inflow. So what will be the discounting factor? 1 raised to power 1 plus 0.1 raised to power what? Year 1. That will give us what? Let's be fast. 0.0090. Am I right? So let's multiply it. Let's be fast. Where? Okay. So year 2 will be 50,000. That will be 1 plus 1 plus 0. 1 over 1 plus 0.1 raised to power 2. So year 3 is 50,000. Raised to power 3. Yeah, what will be the discounting factor? Let's be fast. What is happening today? 0.82 26.
Then 6.
Okay.
Are you not using 3 decimal place?
I'm using 4. But let me use 3. Let me use 3. You can use 4, you can use 3. So let me use 3 so that I can be fast.
The second one is 0.751.
Is 0.751. So 50,000 times 0.909 will give us what? 45,000 for
The next one, 41,300.
41,300. Are you sure?
The next one, yes. The next one,
30.
7,550. 550.
550. Are you correct? Oh yeah, let's add it together. What do you call the first one? 45,000. Well, someone should confirm this figure.
It's correct.
Well, add it together. Add it together. What do you have? This minus 100 plus 45,450 plus 41,300 plus 37. 24,300. Now, I want to ask, don't forget that it is in cedis. 305.
No, it's 300. 24,300. That first year is 5,450.
Okay, 450. 5,450, right?
Yes, sir.
Okay. Now, don't forget, what have we done? We have calculated the NPV in what? We have calculated the NPV in cedis. We now translate it. That's what they say. Discount the cash, the foreign currency cash flow using the foreign discounting rate and translate it to domestic currency. Now, look at it now. After you translate, what did it give us? Is it positive NPV or negative NPV? It's positive. So the NPV is positive. So NPV. Don't forget that the NPV we have calculated is NPV in cedis. Am I communicating? So now, they said we should calculate the NPV now. The NPV in Naira, right? Don't forget it's Nigeria, in Naira. What did they say we should use? The spot rate, right? What's the spot rate? It's 50 Naira. Don't forget that they said that 50 Naira is equivalent to what? To 1 cedis. Am I communicating? Yeah. So look at it now. So this is cedis. That means to calculate the NPV now. Are we together? The Naira NPV. Are we together? It will now be, let's say this one is A. Am I communicating? So to calculate the NPV now in Naira, I'm coming in so that you will get what I'm saying. So NPV in cedis. So NPV in Naira. So NPV in Naira will be what? It will be, because we said we have 24,300. 24,300 will now be 24,300 cedis. For us to get it in Naira, don't forget that 50 Naira is equivalent to 1 cedi. So what you will do is multiply. So it's 50 Naira times what? 24,300 cedis. 24,300 cedis. What will you have? 1,250,000. 2 what? 200 and what? 1,000. Are we together? So this is the NPV. Now look at it now. If the NPV in cedis is negative, you should not even bother yourself. You should know that the investment should be rejected in the first place. Am I communicating? So let's calculate for second method now. So we want to solve method 2 now using the same question. But method 2 says translate the foreign cash flow. The foreign cash flow to domestic currency. Because if the foreign currency is if the cash flow is in foreign currency, you translate it to domestic currency, and after you have done that, you now discount it using the domestic discounting rate. So let's solve this now. Alright. Now don't forget we have here. So we have here. Don't forget the cash flow, which is in cedis. So here is 0. The cash flow, which is cash outflow, is 100,000 cedis. 100,000 cedis. Year 2. Now, for those that understand discounting factor, just like the question we solved, you can find instead of, because it's 50-50, so you can just say year 1 to 3, which is 50. So you can calculate the discounting factor, the annuity. That means I think is 1 plus 1 plus r raised to power 1 minus. Am I correct? I think this is how to calculate the accumulated discounting factor for the 3 years. Am I right? I think so.
Yes, sir.
I'm right. Okay. So you can do that instead of calculating for year 1.
Minus 10.
This one is minus 10. Okay, thank you. Minus 10. So instead of calculating for year 1, year 2, just because the cash flow is the same thing for year 1 to 3, just write 50,000 and calculate it with this. So should we use this or should we use the one we have been calculating? This one will be fast. I hope everyone understand this. That's why I allow Mr. Ezekiel to teach you investment appraisal before taking this.
Yes, sir. This is magnetic formula.
Thank you. Annuity formula. But if the cash flow is not the same amount, don't buy use annuity formula. It's because it's 50 consistently for the 3 years. That's why we are using it. Okay. I don't see anything. Am I communicating? But however, in this question we just saw, you can't use annuity formula for this one we want to do. The first method that we did, you can use annuity. Because this one, he said we should translate it to what? We should convert it to domestic currency. That means each year, we should be calculating the equivalent amount in domestic currency. And don't forget that there will be fluctuation. The interest rate today may not be the same in the next year, may not be the same in the next 2 years. So you can't use annuity to calculate this one. So please, for the first one, so that you can be fast in the exam, and we did the first method, because they said we should calculate the NPV of the foreign NPV first. So you can use annuity for that. So please just know that. So year one, you have 50,000. Year two, 50,000. Year three is 50,000. So let's calculate the spot rate now. Am I communicating? So let's calculate the spot rate. What will be the spot rate in year zero? Year zero is now. That is year zero. Are we together? And what is the spot rate? They said the spot rate is 50 naira is equivalent to 1 cedis. So that means 100 to get, we want to get the cash flow. Don't forget that I said we should translate the cash flow to domestic cash flow. So we want to calculate the cash flow, the domestic cash flow. That means in naira. That's what we want to calculate now. Am I communicating? So 50 times 100,000. How much did that give us? 5 million, right? 5 million. I think so. Now, what will be the spot rate? What will be the spot rate in year one? So for you to calculate the spot rate in year one, you need to predict the future rate. How can you predict the future rate? Now, this is the formula. We have done that before. But this is the formula. So they've given us the discounting rate. That means the interest rate, right? Now you can use what we call interest rate parity what? Interest rate parity theory. And what does interest rate parity theory says? Am I communicating? That spot rate, is it quoted using direct or indirect?
It's direct.
It's direct. This is what interest rate parity theory says. That for you to predict the future rate, or you call it the spot rate at the future, is equal to the spot rate now times 1 plus the rate, the interest rate at the what? Domestic interest rate, all over 1 plus interest rate of the foreign currency. Do you remember? If this is direct, if it's direct quotes, this is it. I think we have done that. Now, if it is indirect, this is the formula you use. So it will be 1, the denominator will become the numerator, and the numerator here will become the denominator. So 1 plus the interest rate of the foreign currency plus over 1 plus the interest rate of the domestic. So this is if it is direct. If it is indirect quotes. You already know this. Am I communicating now? So let's predict what the spot rate will be. Since we say it's direct, because they said it is 50 naira is equivalent to 1 cedis. That's direct. And direct, what is direct saying? Direct is the number of unit of domestic currency that is needed from 1 unit of foreign currency. Am I right? Okay, by now we should know it too. So which one are we going to use? The first one. Now, I also want to note something. N should be there. Are we together? N should be there. That is the number of years. So it's the first one we should use. So we should use the first one. So let's use the first one to calculate the spot rate now. So for year one, since we know the formula, so let's predict the spot rate. What is the spot rate? 50 equals to what? 1 plus, what is the interest rate or discounting rate for
8%.
domestic 0.08 plus all over 1 plus the discounting rate or the interest rate of the foreign country is what? 10 raised to power 1. So what will you have? Let's be fast. What will you have? What will be the spot rate in year 1? Well, let's be fast. Let's be fast.
49.1.
49.09, right?
That's why.
Yeah. Now, look at it now. For year 2, just change the n to what? To 2. So what will you have? You see the same thing. What will you do? What will you do? 48 point what? 2. Now look at it now. You can calculate it in another way like this. Look at it. You can do it like we say it's 48.2. You can also calculate it like this. The predicted spot rate can be, what is the spot rate in year 1? 49.09, right? So it can be 49.09 all over 1 plus 0.08 divided by 1 plus 0.0.0.10. What will you have? It should be 48.2. Am I right? Is it correct? You will not put n here. You will not put year. You will not put year 2 here. But if you are putting n there, that means this 50 must be constant throughout. So you can do it in that 2 ways. So let me. So 48.02. So for year 3.
So we approximate it to 48.2.
Okay, thank you. Thank you.
You see, it's relevant.
Yeah, thank you. So what would be for year 3 now? So the same formula too. So that would be 50. Okay.
The second year is 40.2.
So for the third year, what will be the third year? So 0.08. 1 plus 0.1 raised to power 3. So let's be fast. 47.3. 3 what? 2. Okay. Now, since we have predicted the spot rate. Okay, 2. Okay, thank you.
48.20, yes.
Yeah, thank you. Now, since we have calculated what the spot rate will be in the future now let's now translate it to cash flow in naira. Don't forget this one will be negative, right? So this time this will give us what? Well, let's go back. $2 million. 2 million 4 5 500. So this one 50 times this will give us what? 410,000.
Yes, sir.
This time this.
this thing.
Where?
The last one, 2 million
366,000.
Yes, sir.
Now, look at it now. Since we have converted, we have translated from foreign cash flow to domestic cash flow. What they say we should do now? Discount it using the domestic discounting rate. What's the domestic discounting rate for Nigeria? So for year 1, it will be 1, right?
Yes, sir.
So calculate for year 2. I said for year 1. For year 0, it will be 1. For year 1, now it will be 1 all over 1 plus 0.08 raised to power 1. So what will we get?
0.926.
Is 0.926. 926. Okay. For the second year, raised to power 2. 0.857. Okay, for year 3. 0.794. Can you see now? Can you see that? Can you see the reason why you can't use Hamilton formula for the discounting rate now? You can see the figure is different. Unlike here now, it's the same thing. But when you now translate it to Naira, you can see it's different. So now let's calculate the present value. So this one will be 5 million. Can you see the board? Can you see the board? So 5 million times 1, you have 5 million. 2,454,500 times 0.926 will give us what? 2,272,867. So 2,410 times 0. 065 370.
The next one,
204. No. 604. Okay. So let's add it together now. Don't forget that the NPV you are calculating is in Naira now. 1,216,841. Now, this first method should be the same with the second method, but however, maybe because of approximation. Are we together now? Now, the answer will be the same thing if you are operating in a perfect market. Now, what do you mean by a perfect market? Perfect market is when there is no restriction. You know, the 50,000 they are saying we should receive now. Look at it. The 50,000. What we call? The 50,000 CDs. We will collect it at when it is due. There is no restriction to it. Am I communicating? There is no restriction to how much you can receive as cash inflow in that country. Don't forget that the 50,000 CDs will be paid by the what? It will be received by the company which has invested by that Nigeria company. They will receive the CDs. and there is no restriction to the amount you can receive from Ghana. Am I communicating? Am I communicating? Hello?
Yes, sir.
Okay.
Yes, sir.
Now let's look at this.
Can you just explain to me?
Now, what I'm saying is that what the question we have solved now, it is on perfect market. That means there is no restriction to the amount you can receive as cash inflow. Let's say in Ghana, they put a restriction that, okay, let's say they put a restriction that once you invest, that when you invest in Ghana projects, that before you can receive the money, that means the cash inflow is going to be after 2 years. That means in year one, what happened? Am I communicating? That means in year one, what happened? They will not receive any money. Am I communicating? So,
Sir, go run through that spot trade. How you got it?
okay, the spot rate. Okay, we have done something on the spot rate before. So this is it. Let me. So if there is market imperfection, example like restriction, am I communicating? Like restriction, the same question we solve now, that's what we want to solve again. But however, the restriction will not affect method 1. Please note that the restriction will not affect method 1. Okay. Is it okay like this? The restriction will not affect, what do I call it? Method 1. Am I communicating? The restriction will not affect what? Method 1. Because what does method 1 say? It says we should discount the future cash flow using the foreign currency rates. Am I communicating? It will not affect. Because if you are using the foreign currency, the discounting the foreign cash flow and using the foreign discount rate, you are assuming that the money has not moved out of that country. So let's go to the question first so that I will not overbore you guys with what I'm saying. So page 502. Page 502. 502. So let's look at the question. So let's read. In the same question. So let me read. It said a Nigerian company is considering investing in a project in Ghana, and the current exchange rate for Ghana cedis is 50 naira to 1 cedis. The discounting rate for the project in Ghana is 10%, and the discounting rate for the similar projects in Nigeria is 8%. Look at the clause they put now. They said the project will require an initial investment of 100,000 cedis and lead to cash inflow of 50,000 cedis per annum. They said for the next 3 years, however, the Ghana government has imposed a complete ban on the amount to foreign investors. That means the amount that a foreign investor can receive. He said this ban is expected to last for 2 years. Is expected to what? To last for 2 years. Am I communicating? So if it is expected to last for 2 years, who can explain now? Who can explain what will happen? For method 1, the way we solve method 1 for this question, it will not affect. We'll solve method 1 the way we have been solving it. Why? Because I know some people ask why. The reason why method 1 will remain constant, will not change, is because that the method 1 says that we should discount the future, we should discount the foreign currency, the foreign cash flow, using the foreign discounting rate, right? Are you getting that? After we have done that for the years, we now translate it to the domestic currency, right? So for the years in which we are calculating the discounting factor, it is being assumed that that money is still in that country, right? Am I communicating?
Yes, sir.
So it means that the way we calculated for the first question, this question, that means the question in 500 and this question for method 1 will still remain the same. Are you getting what I'm saying now? I don't want to recalculate it again. So I will recalculate for method 2. If you look at the workings in the material, you see that it is the way that's the way in which they calculate it. Am I communicating? That's the reason. Even though there is restriction, we are still using the cash flow of the country as if the money have not moved out from that country. If you are calculating the NPV, are we together? You know, it is after year 3 that you now calculate the NPV and convert it to the domestic currency. So let's calculate for method 2 now. So we will not calculate for method 1 again. It's waste of time. What's the time, sir? Okay. Now let's calculate for method 1. For method 2 now. So now look at it now. Year 1, how much is the cash flow in cedis? That's 100,000 cedis. Am I communicating? What is the spot rate? The spot rate in year 0, so I think year 1, mean year 0, rather. Year 0. The spot rate will be what? 50 naira. Am I communicating? Now, what will be the cash flow in naira if you convert it? That is 50 times 100,000 will give us 5 million. Now look at it now. They said Ghana has put a restriction on the amount of cedis that can move out of their country, and that ban is for 2 years. That means no money. Even though that means your money will not be accumulating, it cannot be converted or move out from the country now. They said for 2 years. That means the cash flow for year 1 and year 2 will be received in year 3 together with the cash flow of year 3. So how much are we going to be received in year 3? So in year 1, don't forget, year 1 there will be cash. So year 1, year 2, year 3. So in year 1, you don't need to waste your time. Dash. Year 2, dash. So that's why I skip year 1 and 2. Don't waste your time on it. So we'll now start from year 3. So how much are we going to receive in year 3? How much are they going to receive? 150,000. The ban may not be on restriction on not receiving money. It may be on an amount. They may say the amount that is permitted to go out of the country is, let's say, 30,000 cedis. That means for year 1, how much will go out? 30. The remaining balance will be 20. That 20 will be year 2. 20 plus 50 plus 50. That's 70. And the amount the amount that you can transfer for a particular year, let's say, is 30. So for year 2 now, out of 70, it will be 30 that you can recognize. So it will mean another 40. I'm just giving you an illustration on what restriction they can be. It may not be totally banning the amount to be received. It may be on a particular amount. They may put a restriction on a particular amount. So don't let me over-explain. Now, year 3. So just calculate the spot rate for year 3. Am I communicating? We already know.
47.3.
So we have calculated it already. And if you don't know it, it is F equals to spot rate, which is 50 times what's the interest rate of the domestic 1 plus 0.8 over 1 plus 0.01 raised to power 3. So So 47.33. So 47.33 times 150. 7 million. 7 million what?
098,000.
Okay, 98,000. Am I completing? So let's calculate the discounting factor. So the discounting factor for year 0 will be what? Will be 1. What will be the discounting factor for year 3? Just calculate the discounting factor for year 3. 1 all over 1 all over 1 plus 0.08 raised to power what? 3. What would that give us? The 0.77 what? We have calculated it before, yeah? 794, right?
0.794.
Okay, let's multiply what you have. So this one will give us half, and even bracket it. Minus 5 million. 7,098,000 times 0.795 will give us what? 5,635,812. So the NPV, that means the NPV in naira now. Don't forget, it should not be 635,812. I think so. Eh? So let's look at this question. It's drafted from Omolenwa. He said, Ife Limited is evaluating an investment overseas in US, a politically stable country. The project involved the establishment of a training schools to offer courses on accounting, banking, and finance. That's the project they want to involve in. He said it will cost an initial of $10 million. It is expected to earn a post-tax cash flow as follows. This is the cash flow. I don't forget that we are approximated to the nearest thousand. So this is the cash flow that you earn. So the project is for 4 years. So first year you will earn 3 million. The projected cash flow for year 2 is 4 million. This is 5 million. This is 5 million. Don't forget that we are approximated to the nearest what's it called? 1,000. He said the following information is available. He said the expected inflation rate in US is 3% a year. He said the real interest rates in the two countries are the same. The real interest rate in both countries is the same. He said the current spot rate is $2 is equivalent to 1 naira. I praise you. 2 naira is equivalent to $2 is equivalent to 1 naira. The fixed rate interest in US is 7% and 9% in Nigeria. In USA is 7%, in Nigeria is 9%. That means the interest rate. If I require a naira return from the project of 16%. So the required return is what? Is 16%. Am I communicating? They now say require calculate the NPV of the project using that in your exam. That's why it's very important for you to understand what we have been doing. He said by discounting the annual cash flow in naira and by discounting the annual cash flow in what? In dollars. Am I communicating? He said we should discount the annual cash flow in what? In naira. So let's calculate discounting the annual cash flow in naira. So who can tell me what are they asking us to do in method One.
Method one, we have to translate first.
Translate first. Mhm. Before we discount it. Okay. What about in method in 2?
Discount before we translate.
Discount using the foreign discounting rate, right?
Yeah.
So that means in this, by discounting the annual cash flow in naira, which method are they asking us to use? Method 2. So by discounting the annual cash flow in dollars, is which method are they asking us to do? Method 1. Thank you. So let's do for method 2 now. Am I communicating? So let's solve. I'm coming. Let me adjust the. So now, so let's solve for method 2. That's what they're asking us in this question. Method 2. So now, question 1, he said we should do what? By discounting the annual cash flow in naira. Am I communicating? So what is the first thing you should do? Let's hear. Am I communicating? Hear the cash flow. Don't forget that the cash flow they will be receiving is in what? Dollars. So the cash flow in dollars. So after we have done calculate, we calculate the what? The spot rate for each of the year. Now we now calculate the cash flow in naira. Let's do that first before we now calculate the NPV. So let us do that. So for year 1, what is the, okay, let's try to approximate it. So that's it will take time. Or should we not approximate it? Okay, let's approximate it. Let's use the whole. So what in year 1, what is the initial outlay? What's the initial outlay in year 1? $100 million. I said $100 million. $10 million rather. 10 million. What's the spot rate in year 1, in year 0 rather? What will be the spot rate? Don't forget that they are giving us that they say, look at it, don't miss it up. They said, look at it, they said $2 is equivalent to 1 naira. Are you going to use 2? Don't forget they are converting it to naira. You are saying this is in dollars. So how much is a dollar? $1. How much is the equivalent to in naira? So that you can multiply it. Are you getting what I'm saying? Now that means for you to do that, this question is it direct or indirect quotes? This is indirect, right? So it is indirect quote now. Am I communicating? You say it's indirect, right? Now that is for you to know how much $1 cost in naira. You need to convert it. So it means 1 divided by 2 is going to give us what? 0.5. So 0.5 naira is equivalent to what? to $1. Do you get it now? Are you getting what I'm saying now? Do we understand this? Because this is dollars, you want to convert it to naira. You can't multiply by 2. Because we want to get, this is in dollars. And you see the exchange rate, they said $2 is equivalent to what? To 1 naira. That means you are not converting dollar to naira. You can't multiply by 2. You need to know how much, what is the equivalent amount of $1 in naira. So when you know it, that's when you multiply it. Am I communicating now? So $1 is how much? Is 0.5 kobo, right? Okay. So the spot rate will be what? Is 0.5. So 0.5 times this will give us how much? Don't forget it is outlay. It will be bracket. So 0.5 times 10 million will give us what? I think 5 million. That will be half of this. Am I communicating? So after we have converted it now to naira, what next should we do? What's the next thing we should do? We should calculate the what's it called? The discounting factor. So the discounting factor, that's what we should calculate. What do they say the discounting factor is? They say if effect require a naira return from this investment is 16%. Am I communicating? So the naira return you are going to use, the discounting factor you are going to use is what? Is what? Okay, at 16%. So calculate the 60% of this. Are we sure we are still here? What is 16%? Oh yeah, let's be fast. For year 0 it will be 1, right? So the NPV, which will be in naira, will be minus 5 million. Are we together? Are we together? Do we understand this? Okay. For year 2, how much is the cash inflow for year? I say for year 2. For year 1, what's the cash inflow? 3 million is the question. So do we know the spot rate? Do we know the spot rate? So we need to calculate it now. So now, what are we going to use to calculate it now? Is direct we are going to use it because the spot rate is now at year 0 is 0.5. And which is calculated using what? Direct. So it will be the spot rate at year 0 bracket 1 plus the, what did they give us? They gave us the interest rate. They said the interest rate are domestic and the interest rate are what? Foreign. Raised to power what? N.
That one, you know, is an indirect mode, right?
No, we have converted it to direct. That 0.5 is not direct.
Okay.
So you get it now. So it's direct that we use.
What do you say? It's no longer indirect.
It's no longer indirect because the spot rate now is at 0.5. Don't forget the 0.5 is saying 0.5 naira is equivalent to what? To $1. Are you getting what I'm saying? Hello? Do you get what I just said? If you don't get it, please, you ask the question, do you get it now?
Yes, I do.
Now, what I'm saying is that we have converted it from indirect to direct. Don't forget that what they quote was $2 is equivalent to 1 naira. Now, if in Nigerian view, don't forget Ife Limited is a Nigerian company. If something is quoted, this is what they quoted in the question. What is that? Is it direct or indirect?
Indirect.
Indirect. Don't forget that indirect says the number of unit of foreign currency that is needed for 1 unit of the domestic currency. Now we now converted this indirect. This is indirect. We now converted to direct. How do we convert to 1 divided by 2? This 1 divided by 2, it gives us 0.1. So what do you mean? It means 0.50 kobo is equivalent to $1. What is this? Is it direct or indirect? Is it direct or indirect? This is direct. Direct, don't forget, direct says the number of domestic currency that is needed for 1 unit of foreign currency. So for you to get the equivalent cost or amount of $1 is 0.50 kobo or 0.50 naira. That is direct. So you can't be using 0.5 as the spot rate and be using indirect. Are we together? So the formula you use will be direct. Do you understand it now? Hello? Just follow me. Now, what is the exchange rate in the question? What's the exchange rate? It is $2 is equivalent to 1 naira. And we all agree that this is indirect because from Nigeria, Ife Limited is indirect because Ife Limited is a Nigerian company. So don't forget that they say indirect is the number of domestic currency. Domestic currency is what? Dollars. That is needed for 1 unit of the number of unit of foreign currency that is needed for 1 unit of domestic currency. Now, look at it now. They now say the initial cash flow, that means cash outlay is 10 million. Now, I want to convert this 10 million to the cash flow in naira. Is it going to be times 2? You are not going to be times 2. But what you are looking at is that you want to convert $10 million to naira. And they said $2 is equivalent to 1 naira. So if you are converting, are you going to multiply by 2? It's just that if you want to convert it to be 1 over 2 times what? 10 million. That's the implication now. Am I right? That will give us what? 5. That will now be 5 million. That's the implication. You get it now? You follow what are you following what I'm doing?
Yes.
Yeah. Look at it. If you don't understand, let's do that. They said you need $1, $2 to get 1 naira. Let's say this is dollars and this is naira. Look at it. $2 is equivalent to 1 naira. Now look at it, man. If they now say you need how much we 1, 2, 3, 4, 5, 6, 7, 8. $8. How much will it be? How much will $8 be in naira? How much? 4. Because 2 of it is equivalent to 1 naira, so it will be 4. So look at this now. The now say $10 million will be equivalent to what in naira? Are you ready? So if 2 is equivalent to 1, just divide it by what? By 2, right? It will give us 5 million. So, but in exchange rate, you have to know the rate per 1. So what we do is that if 1, just divide 1 over 2, we give you what? 0.5 naira. 0.5 naira. That means what we are saying is that in this interpretation, $1, are we together? $1 is equivalent to 0.5 what? Naira. That's what they are saying. So for you to convert now, you need to get the spot rate, which is how much is $1. Now, ma, how much is $1 now based on what we have calculated? So if $1 is 0.5 and you have $10, $10 million, what will you do with it? Multiply it. So it's 0.5 times $10 will give you what? $5. Don't forget that based on this is 0.50. We have converted direct that was given to us indirect quote that was given to us in the question to what now? To direct. Yes. So the spot rate that we are calculating here is direct, is not indirect quote again. Even though it's what we are giving in the question. So for you to predict the future spot rate now, you can't use the formula that you use, it can't be indirect. The formula you use, it will be for direct because your spot rate is at what? Direct. Are you getting what I'm saying? Do you get me now? Okay. That it is direct that you use to predict the future spot rate, which is the spot rate at year 0 times 1 plus the interest rate of the domestic over 1 plus the interest rate of the foreign raised to power n. So what will be, this one will be 0.50 times 1 plus, what is the interest rate in Nigeria? Don't forget Nigeria, it will be 0.09 all over 1 plus 0.0. What is in US? 7 raised to power what? 1. So what will you have? Yeah? Is 0.509, or let's make it 4 degrees. 0. This will be 3, right? I think so. So for so this times this will give us what now? So if you know the spot rate in year 1 now, it will be 3 million times 0.5003. Let's be fast. Let's be fast. This is where we are getting interest rates. This is what we are working with. Yeah? Let's be fast. 1. I know it can't be 0. It's 0.5093 times 3 million. 1,527,527. Sir, call it properly. Yes, 1,527,000. Yes. And 900, right? 527. 900. Okay. 900. Now, since we have calculated for that, okay, let's calculate for year. Let's just calculate the spot rate so that it will be easy for us. So what will be the spot rate for year 2? Let's calculate for the spot rate so that we won't waste time. We will going. So year 2, just change it to 2. What will be the spot rate? 0. What? Oh yeah. 0.5188. So 88. So let's for year 3. What will be for year 3? So just change it to year 3 then. Just change it to 3.
Year 3, 0.5285.
0.5285. 85. Okay. For year year 4, 0.5 what? 5384. Okay. Now don't forget the cash flow for year 2 is 2 million. Sorry, it's 4 million rather. It's 4 million. So 4 million. For year 3 is 5 million. For year 4 is 5 million. So let's multiply this. Yeah, someone should, let's be fast. 2,075,200. For year 3, you can approximate, you can let's have 889. Okay. Approximate. So this one is it? 86. Okay. So is it correct now? Is this one still correct? We have multiplied it now. Change it. Let's be fast. Let's be fast. Okay, this one will be 2 million what? 2 million. Oh yeah. 4 million times 0.5189. Oh yeah. Let's be fast. It's because I don't have calculator. Let's be fast. I don't have calculator here. Let's be fast. Oh yeah. What will this give us now after I have changed it? Okay, 600. Oh yeah. 5 million times 0.5286. 2,243,000. 2 million 2 million 2. It's not like I hear you. I can't hear. 264. 2 million. Okay. 2,643,000. Right? Is it correct? Okay. Next one. Eh? 2 million 692. That's all. 1,000. So let's calculate the discounting factor now for 16. So we already know that the discounting factor for this one will be 1. So if it is 1 times this will give us minus 5 million. So for year 1, don't forget it is 1 over 1 plus 0.16 raised to power 1. So what will it be? 0. What? 8621. The second year. 0.74 3, 2. The next one is what? 0.607. You know, okay, 0. What? 35. 0.5. 5 what? 5. So now, since we have gotten the discounted factor at 6%, so let's multiply this. So if we this time this, what will it give us? Let's be fast. This times this will give us what? So 1,500,000. So as we are writing the year 1, some people should be doing for year 4 and be calling the figure for me so that we can. So for year 1, what's what? 1,000,000. Wait, 1,000,000. 3 what? I can't hear you guys. Let me see whether I can. Okay. 1,000,000. 1,000,000. 3 what? 20. What are we calling it now? 1,317,000. 200 and for year 2. For the second one, right? For the second year. Okay. 1,542. 586. Okay. Well, for the third year. Okay. 1,693,000. 370. Okay. Now for year 4. 1,486. 792. So let's calculate the NPV now in error. So NPV in error. That's what we say we should calculate. So yeah, add it together. Yeah, we see now. 16% is in the question. Additional information 5. It said if they require a naira return from this investment of 16%. Man? 16%. Yeah, this is 1/1 plus r raised to power what? N. No, N. No, yes. Okay, you can do it like that. But this is what me I'm used to. So you can do minus, if you know to put the raised to power 1, so it will be minus N. And that's what I'm saying now. Or 1 plus r raised to power minus N. It's still the same thing. Alright. Sir? Okay. Let's continue. Okay. 1 million. What do you call it? 1 million.
1039.
1 0. Wait. Wait. 1 0. Wait. You know what to do? Just for 1 million. 1 million.
3995.
Wait. 1 million. 039. 951. So that's for this. So let's go to. Now you ask a question that we are going to use inflation rate. Now look at it. They gave you a question. They have given you the interest rate, which is for both countries, 7% and 9%. Now in this question, they have given you inflation rate. When you use inflation rate in four-way equivalent, where do you use inflation rate? Thank you. So if you are giving inflation rate in US, which is 3%, and you are not giving the inflation rate in Nigeria, are you going to use the formula? Is it not this one that is available to you that you use? Are you getting what I'm saying now? You use the interest, because the interest of both countries are given to you. Am I communicating now? So what is the question? What I'm saying is that they will give you the return on the project, on that investment, meaning the cost of capital. Are we together? Or the interest rate on that project, what is going to yield. And if you look at the question, they gave us as 16%. That's why we are using the discounting factor of 16%. Now, someone asked the question that, why are we not using 9%? Now, the reason why we are not using 9% is that the interest rate they gave us, they said 7% and 9%. They said is on what? Risk-free rate. And risk-free rate interest is peculiar to free risk investment. And this project is not free risk investment. Investment that has a lower risk or is zero risk. An example of that is government bond. Is free risk. We did that in portfolio. So you are not going to use that because they are not telling us that the free risk rate interest in Nigeria and US, they are not telling us the expected return on the project. So it is the expected return on the project or the interest on the project that you are going to use, which is 16%. Madam Dolato, Modupe, do you understand what I just explained? So let's do the second method. So now, so the second one is counting using what? In US. I think that one is somehow straightforward, but there's a problem. But don't let me talk about the problem yet. Let me clean the word. Now, we have here what? So we are solving by discounting the annual cash flow in dollars. So that one is the first method we mentioned when we are solving the past question. We say discount the future cash flow using discount the foreign cash flow using the foreign discounting rates. Am I correct? And translate the cash flow into the domestic currency using what? The spot rate. So year zero, what is the cash inflow in the foreign currency? That's 10 million. Now, discounting factor. Do we know the discounting factor? No. Do we know it? Were we giving the discounting factor? No. They said it will require a naira return. So they didn't give us the dollar return. So we are not giving the dollar return in the question. Am I communicating? Were we giving? No. So how can we calculate it? You can calculate it using this formula. And what's the formula? F equals to spot rate now times. Now don't forget that we are calculating the cash flow in dollars, right? Am I communicating? Am I communicating?
Yes.
So if you are calculating the cash flow in dollars, that means you use the indirect quote method. What did I say? The indirect quote method for interest rate parity theory. So what's the indirect? It will be 1 plus RF over 1 plus RD. So you will use it to solve it. So you don't need to stress yourself by looking for subject or formula. It means this formula is like this. It means it is 1 plus 1R over F. 1 plus RF plus over 1 plus RD equals to spot rate divided by what? Features. Because when you find the subject of formula, so what we are looking for the subject of formula. So it can be translated as this. And you can use this. I don't want to waste time. Or you can, let's use this. So let me use this so that you not say, where did I come with this formula? So let me use this formula. So this is the indirect quote because we are using is domestic, is the foreign currency we are using. So forward contract, forward rate, forward spot rate is equal to spot rate now plus 1 plus the interest rate of the domestic of the foreign minus all over 1 plus the interest rate of the domestic. So the interest rate of the forward, are we together? We have calculated in question number 1. Are we together? In number 1, what is the forward rate for year 1? So you use year 0 and year 1. We need to stress it. So the forward spot rate for year 1, what is it? Don't forget that we are looking for the interest rate of the foreign, that is the interest rate of the foreign currency that we are looking for. Because that's what, by the time we are able to find it, that's what we use for our discounting factor. So if you are not giving the discounting factor, if you are giving the discounting factor of the foreign now, and you are not giving for the domestic, we can use this formula to find it by making either RF or RD to be subject of formula. Do you understand what I just said? Hello? What I'm saying is that this formula, because we are looking for the cost of capital in dollars. So what we are going to use, the interest rate parity theory we are going to use is what is it called? Is for indirect, and this is indirect. And I told you that interest rate parity can also be used to derive the cost of capital for either the domestic interest rate or for foreign interest rate. Because the interest rate for the project was not given for the foreign, but it was given for the domestic. Do you understand what I just said now? So what I just said is that the forward spot rate for year 1 is what? Is 0.50 what? Someone should call it. We calculated it now. 93, I think so. Yeah, I know. Don't worry. What we are after is the interest rate. It's not the dollar we want to convert. We are not converting. Are you getting what I'm saying? Look at it now. What is the spot rate? Yes, that's what I'm saying. We are not concerned about the whether it's in. So what is the spot rate? 50, right? I say 50, 0.50. So what is the interest rate in domestic? Do we know it? No, it will be 1 plus interest rate of the foreign. The foreign, we don't know it. So 1 plus the interest rate of the project in domestic currency, what is it? Yes, 60%. See, that will give it. They said, Ife require a naira return from this project of 60%. So we are not giving the dollar return of the investment. That's what we are trying to derive. Because you need the return in order to calculate the discounting factor. Are you getting what I'm explaining now? So that would be 0.16%. So let's calculate now. 0.50, that's 1 plus divided by what? 0.16. This one is 0.5. So divide both sides by what? Hello? Hello? Oh yeah? So let's try to find R now. So how can we find R? So instead of making this difficult for you, just use this formula. Because I think the time is fast approaching. Just use this formula. This is still the same formula. Just divide, just add 1 plus R over 1.116 equals to, what's the forward contract? What's the spot rate? 0.50 divided by what? 0.5093. So cross multiply. What I'm saying is that, hello? What I'm saying is that you can interpret this formula to be spot rate over forward rate times 1 plus R F over 1 plus R D. That's what I'm saying. That instead of you opening brackets, typing bracket and all these things will not take time. That's what I'm saying. Are you getting what I'm saying? Hello? Hello?
Sir, we are here.
Do you understand what I just said? What I'm saying is that this formula and this formula, especially when you are deriving interest rate, is the same. But this one will be easier for you to quickly manipulate than this one. That you need to divide both sides by multiply this, divide this one by 50, multiply this by this. Okay, don't let me talk. So we are cross multiply 1 plus RF times 0.503 equals to 0.50 times 1.16. What would that give you? Where? Is 0.50 times 1.16. Where? Now. Are we tired? This one will give us 0.1 times 0.5093. 0.5093. This one will be plus 0.5093 RF. So this one will give us
Equals to 0.58.
0.58. So 0.0093 RF. So this one cross here, it will be 0.58 minus 0.5093. What will it give? What will it give you?
If you minus it, it will give you
0.007.
No, sir.
Eh?
No.
0.07. Right?
Yes.
So divide both sides by 0.503. So what would that be? 0.1388. So if you are to calculate it, that would be what? In interest rate, it will be what? 13.88%. So in percentage, it will be, you know, when you multiply this by 100, it's going to give you 13.88%. Am I communicating? That's the only difficulty in that question, in this method. Because you are not giving the interest rate or the return in dollars, and you are calculating you are discounting the annual cash flow in dollars. So you need to know the return in dollars. That's the main thing. So we have calculated the return in dollars. Do we all understand this? Do we all understand this? No, it's not going to be, it's going to be indirect because it's in dollars. We are calculating the cash flow from the viewpoint of the subsidiary now. We are calculating the NPV from the viewpoint of the subsidiary. So what will the subsidiary be seeing the cash flow? They will see it from the viewpoint of indirect. Do you understand? Because it's in dollars, so it's indirect to use. Are you getting it? It's indirect. So, but if you are, assuming you are giving a question now, and you are calculating the discounting factor now of the what is it called? The return in naira you are not giving, it will be direct because you are discounting the annual cash flow in naira. Okay. So since we know the cash flow now, we know the discounting factor is at what? 13.88%. So let's calculate now. What will be the discounting factor in year 1? That will be 1. So 1 times this will still give us what? 10 million. So minus 10 million. So for year 1, what's the cash flow in year 1? 3 million. So what will be the discounting factor at 13.88%? Let's be fast. So don't waste your time. Just someone should call it from directly from the material so that we can quickly run this place off. Yeah. Someone should call it directly from the material. Yeah. The discounting factor as 13.88%. Is 0. What? 0.8787. Okay. Year 2 will be 4 million. 0.8. Okay. The second one is what? 0.7 what? Let's be fast. 0.7 what? Year 3 is 5 million. It will be 0. What? 0.6 what? 6771. So year 4 is 5 million too. 5,9,4 what? 6. So let's multiply. So this times 3 million.
For year 1 is
2,634. 300. Yeah. For year 2.
For year 2,
084 400.
Yes.
For year 3.
For year 3, 3,385,500.
For year 4.
Year 4, 2 million. Year 4, 2,973,000.
9 what?
973,000. 000.
So where? What would I give you? Two million
200.
So that's the NPV in dollars. Are we together now? So if you are to calculate the NPV in naira now, because you are going to convert it, you know they say after you have used the foreign cash flow, they say you should discount it using the foreign discounting rate, and after that you translate it at the spot rate. What's the spot rate? 3. What's the spot rate? The spot rate is 0.5 now. 50 kobo. It's 0.5 naira. You remember now? Don't forget that this is in dollars. So if you have to translate how much is $1, how much is $1 equivalent to what? To a naira. We've calculated it, we say it's 0.5. Now 0.5 naira is equivalent to $1. So what are you going to do? So it's 0.
You just multiply by the spot rate.
Yes, thank you. So times 2.
It's not showing, sir. It's not showing.
Okay. So 2,002. That will give us 1,038,600. That will be the NPV in naira. If you are using, by discounting the annual cash flow in dollars, this is what you have. Now, please, in that past question, you can look at the written aspects, because you are also asked that you should. I didn't put it, I just concentrate on the calculation. I think they said, what is the possible problem involved in making investments in foreign currency? So we have talked about it. Political risks. We have talked about what's it called? The infrastructural development. We've talked about the exchange rates. We've talked about what's it called? Yes. So please, the economical rate and all those things, please just go and look at it. They can ask you to explain those things. Write it and explain. Now we are done.